Gold is approaching a major liquidity zone right now, where smart money is preparing the next massive directional expansion. My primary focus today is a potential sell setup targeting key liquidity. But there's one specific manipulation condition that must happen first. Most retail traders are looking at the exact wrong level right now. So let me show you where institutions are actually targeting and how we can position ourselves alongside them. The main objective today is the 39.85 sell-side liquidity pool. This is where the high probability opportunity lies. We are stalking a highly specific short setup to capitalize on this, but we aren't just going to jump in blindly. We need to see a precise manipulation phase unfold before we execute any orders.
Let's lay out today's trading blueprint. The daily bias on gold remains heavily bearish. We've been in a firm structural downtrend since the peak in early 2026. The ultimate target is that 39.85 liquidity pool. The primary setup we're looking for is a short position, executed only after a New York news sweep. We want to see price push into our specific entry zone, right between 40.42 and 40.48. If price doesn't reach that premium array, we simply stay on the sidelines.
When we compare the daily distribution to the 1-hour dealing range, the narrative becomes explicitly clear. Institutional order flow is actively driving the price into a deep discount. Every time you see one of these minor bullish corrective rallies on the hourly chart, it's immediately met with aggressive institutional selling at premium arrays. Those prior mitigation blocks and bearish breaker blocks are heavily suppressing the price action. What this tells us is that the algorithm is actively seeking external sell-side liquidity. That recent 4-hour corrective structure wasn't a reversal. It was merely a premium sweep of internal buy-side liquidity designed specifically to initiate a strong displacement down toward the psychological 4,000 level. The market is sending a clear warning signal right now. It's distributing shorts and protecting upper levels to prepare for the next leg down. Now, the critical timing mechanism for this setup arrives exactly at 7:30 p.m. New York time. We have a cluster of high-impact USD news hitting the tape, including core retail sales and unemployment claims. This is going to provide the exact volatility engine the algorithms need to hunt that liquidity. Remember, these data releases aren't random. They are the designated catalysts used to engineer sudden, aggressive price movements. We also have to keep the broader macro context in mind. Geopolitically, we have reports of military strikes between the US and Iran near the Strait of Hormuz, sparking fears of oil supply disruptions. On the macro side, the DXY index is struggling near multi-week lows due to softening inflation data. But as institutional analysts, we don't guess the data outcome, and we certainly don't take sides on global politics. We simply anticipate that institutions will use this geopolitical tension and news volatility to intentionally spike price upward into our premium arrays before dumping the market. The news is just the excuse. Take a look at these relatively clean equal highs, resting right around 40.45 to 40.50. This is engineered inducement. It acts as a trap for early retail shorts, setting them up to be swept out in a classic Judas swing. Smart money always needs counterparty liquidity to fill their orders. By sweeping those buy stops right around the news release, they can build their massive short positions at a premium price before the real move down actually begins. So how do we execute this safely? We rely on the M15 institutional execution model. Step 1, you wait for that 7:30 p.m. news spike to tap into our premium bearish breaker. That's the Judas swing. Step 2, you let price sweep that 40.42 to 40.48 premium array. And step 3, which is absolutely non-negotiable, you wait for a confirmed 15-minute market structure shift lower with heavy displacement, leaving behind a clean fair value gap. If there's no displacement, there's no trade. If that confirmation triggers, here are the exact executable parameters. We enter in the zone between 40.42 and 40.48. The stop loss goes firmly at 40.56 to invalidate the immediate hourly structure. We'll take our first partial profits at 40.20, our second at the psychological 4,000 level, and leave the final objective at 39.85. This setup gives us a highly asymmetric 1 to 4.5 risk-to-reward ratio. But because of the extreme news volatility, you must cap your risk at 0.5% and absolutely do not execute during the exact minute of the data release. Wait for the spreads to normalize. But here's the problem. Where are retail traders going to get trapped today? This brings us to the most dangerous part of the chart, and exactly where the majority of retail traders are going to lose their money. While retail traders are looking at a clean double bottom support to buy at 4,000, smart money algorithms see something completely different. They see a massive, highly vulnerable pool of sell-side liquidity, stop losses just waiting to be purged down at 39.85. Retail is busy trying to buy that support, which is actually actively creating the exact liquidity pool that institutions are targeting for their final distribution run. However, we always remain objective.
This liquidity pool only matters if our market structure holds. The hard invalidation level is 40.65. If we see a 4-hour candle close above 40.65, this entire bearish narrative is completely invalidated. That would signal a deeper, higher timeframe structural shift and likely a retest of the 4100 level. If that happens, smart money confirmation hasn't appeared, and we simply sit out. Let's do a quick final recap. Our bias across the daily and 4-hour timeframes remains strictly bearish. We're looking for continuation. The ultimate drawn price is 39.85. Our immediate action right now is to wait until smart money provides that New York premium mitigation and the subsequent 15-minute confirmation post-snooze. Discipline is exactly what separates retail from institutional trading.
If you appreciate precise, calm, and institutional-grade market analysis using smart money concepts, subscribe to ICT Market Theory. And if you'd like to trade alongside these setups, you can find the FXTM account link in the pinned comment below. Keep your risk managed, trust the structure, and I will see you in the next explainer. The only question you have to answer before 7:30 p.m. is this: will you be the one providing the liquidity, or will you be trading alongside the algorithm?